It was a pretty interesting day in the market. The S&P 500 only closed higher by about 0.24%. However, the breadth was much stronger than what we had been used to in recent weeks and months, with about 2/3 of the stocks in the S&P 500 closing in the green. In fact, today was a rare day where mega cap tech kind of took the back seat and let a lot of the banking stocks in particular lead the way higher today. That allowed the Russell 2000 to absolutely erupt. It was up about 2.7% today, and was really the second out of the last 3 days that it had a massive move higher. So all of a sudden the small caps are starting to come to life. So we'll talk about all of that, see what it means for our posture. We'll take a look at the different macro charts. We'll take a look at the sector charts. Then we'll get into our trade application example, where I wanted to focus on a financial stock, one that's bouncing up and off of its rising 30-day moving average, to see if we can play it from a bullish swing trading perspective. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 6th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. At the bottom of those emails, you'll also find which stocks are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter, so if you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. Got my S&P 500 heat map pulled up here, and before we get started, I just wanted to reiterate my hallelujah that you guys saw from me on Twitter. I think it was late Saturday night, but I happened to log into Thinkorswim on the real money side of the ledger. Remember, for those of you that aren't familiar perhaps with Thinkorswim, they have a paper money side and they have a real money side. So anyway, Saturday night I happened to log in onto my real money account, and I was somewhat excited because I actually saw some movement in terms of the sector and industry reconstitution that took place here in the middle of March that you guys have heard me talking about and somewhat grumbling about since then, because up until this weekend I had not seen Thinkorswim make any moves towards doing that proper update, even though other brokerage firms like Fidelity and others have done that properly already. So anyway, I did notice on Saturday night, and continues to be the case right now, that on this heat map here, it does look like it is good to go on a real money account. Remember, an easy way for us to identify that is to look at some of the bigger companies involved in the switch that took place here a couple of months ago. A couple of the easy ones for your eyes to spot will be MasterCard and Visa. Remember, they used to be technology companies, but with that switch in the global industry classification standards here in the middle of March, they were moved from technology to the financials. And prior to this weekend, anytime I would pull up this heat map with you guys, we just couldn't find Visa and MasterCard. It was like all the stocks that were affected by that industry and sector swap just were basically removed from the heat map altogether. So now that I can see them, and now that I can see they're housed here in the financials, I know that that change has taken place. Remember, they weren't alone, but those are kind of some of the more obvious ones there. Amazon is showing up where it's supposed to be in a new sector, or not the new sector, but the new industry. It was one of those that stayed in the same sector of discretionary but changed industries within it. So it's back on the heat map. You can also see some of the beverage companies that were missing before down there. You can also see like automatic data processing. Remember, that also used to be a technology company, but now it has been officially moved to the industrials. So the point is, this is now the legitimate new view that is accurate according to industry standards. You can also see all those real estate stocks coming back as well. Now, before we get too giddy about this, and I had to even catch myself with it, and you guys kind of saw the follow-up on my tweet, I said, before we get going too fast, I have now just logged into paper money, and on paper money they still have not done the update. So this, what you're looking at right now, is my real money heat map, and the update is officially done. But for those of you that are still logging into paper money and pulling up the same heat map, unfortunately you will not see those changes done yet. So I would assume that if they've gone through the hoops to get things squared away on real money, that they would do something very similar on the paper money side of the ledger, and they'll get that corrected here sooner rather than later as well. But this was the first hint towards actual improvement and accuracy that I had seen from them in the last 2.5 months. So I was excited about that and wanted to pass that note along to you as well. Many of you probably, it's not as useful to you because you're not using it in the same way that I am. Remember, I use a lot of these tools on Thinkorswim to then develop my own tools for market scholars. And so if my input is not accurate, then my output isn't. So the old phrase, garbage in, garbage out. So now that we have a little bit more accuracy up front, hopefully that means I can get on with developing my tools a little bit more appropriately as well. All right, so with that out of the way, let's get into the actual analysis of what we see here today. And as you can see, it was a pretty green day, all things considered, and it was a little bit of a different type of a day compared to what we had been experiencing more times than not in recent months. Remember, we are living through this current era of mega cap tech, especially AI-related names, leading this market higher, and it was a very narrow market is what you'll hear that referred to as, when only a handful of leaders are pulling the rest of the market up with it. Today was not that way at all. In fact, it was, in a lot of ways the opposite, because as you can see here, Apple was down just a touch today. Microsoft was down a touch today. Nvidia was down a little over 1% today. Meta was down. It was up actually earlier in the session, but it finished lower just barely by 0.1%. And then Alphabet did manage to close higher here today. But, most of those mega cap tech and communications oriented companies did close in the red today, yet the stock market closed higher. And so today was a day when the rest of the army put the effort and the hard work in, and the generals stayed back at the camp and drank coffee. And so you can see that as you look at some of the smaller sectors off to the right-hand side here, we see a lot more green patches out there. The area that impressed me the most personally today was the financials, and we'll talk about that here in just a little bit when we refer to the foregrid on the overall indices, and you'll see that the Russell 2000 had an amazing day. Remember, what we're looking at right here is not the Russell 2000. We're looking at the S&P 500. So these are large caps. Russell 2000 will be small cap companies. But the reason I'm bringing that up in this part of the conversation is because you guys that have listened to my analysis since basically mid-March will know that the Russell and the banking crisis have effectively gone hand in hand. As the banks have fallen out of favor, the Russell 2000 has fallen out of favor. Because remember, there's a lot more banks than the big ones that we all know, like JP Morgan and Bank of America, Wells Fargo. There are dozens, if not hundreds, of publicly traded regional banks out there that are in the Russell 2000. And so that's a big part of the driver of the small cap index right now. And today we got a really nice snapback out of the financials, and that in turn positively affected the Russell 2000 in a major way as well. So we'll actually talk about the financials a little bit later when we get into my trade application example as well. But I just wanted to kind of, have you hone in your sights here on the financials. There was one little patch of the financials that really didn't perform up to snuff, and that was kind of in your insurance area. Those guys kind of took the back seat. But as you can see here, especially in the banking area, bright green all around. Bank of America and Truist Financial was up 4%. We had M&T Bank was up 4%. U.S. Bank was up 4.5%. Huntington was up 4.5%. Regions was up nearly 3%. We had Comerica up 7% today. We had Fifth Third up 5%. Those are big numbers, right? So, that was, from my perspective, that was one of the bigger stories of the day. Now, another story of the day that we woke up to this morning that you don't necessarily see highlighted on this heat map because the company involved is not in the S&P 500. Nonetheless, it's noteworthy, and that is Coinbase. Coinbase, of course, is probably the most well-known cryptocurrency exchange. Obviously, I'm not particularly involved in that area, so forgive me if I'm wrong about that, but my understanding of it is that they are either the biggest or one of the biggest. Of course, that's the one that I pay a little bit more attention to simply because it's publicly traded. There's probably a lot of private exchanges and things like that out there as well. But anyway, this morning came word that the SEC was suing Coinbase. And so a lot of those, the cryptocurrency related types of plays, the innovative, disruptive types of areas, started off kind of today on rocky ground as a result of that. So that was a biggie. Again, it doesn't have to impact the whole stock market, but there's a certain corner of the financial markets that had a major landmine here today with that announcement. We also heard kind of an interesting merger in a non-financial market related way, and that was the PGA Tour and Live Golf. Which is the Saudi Arabian-backed golf, network that had been luring a lot of American players away with big bucks over the years. And there's been a lot of controversy around that. But anyway, sounds like they came together today and are actually going to merge to kind of form a mega league. And that will certainly come with a lot of outrage and controversy. But it did end up having a positive impact on some of the golf-related stocks that were out there, like Topgolf, remember, is publicly traded these days. It's technically called, I think, Modern Golf, but they own the Topgolf brand along with Callaway, and then Nike had a reasonable day. There were a handful of other kind of, golf-related types of publicly traded companies that did get a little bit of a boost on that news. So while the news itself from a merger perspective happened outside the stock market, it did have some kind of lingering effects within the stock market itself. Besides the financials, I would say another area that looked reasonably good today is probably the discretionary stocks. You had a lot more green than red in that particular area. You would also say that the industrials seem to handle things reasonably well today. A few more green than red there. And then I would also say that energy did reasonably well today. With much more green than red. You had a stock like EQT here that was up 3.5%. What was kind of interesting today is that what we had been seeing more times than not is that consumer staples and technology were kind of moving in opposite directions. What was more to the point was technology was going up and consumer staples were going down. Today, with technology lower, you would have thought that might have been a day where money flowed back into kind of the old school defensive companies as a result, but that really didn't happen today. So the consumer staples continue to lag in this market. Part of it may have been earnings related today as well. I think Smucker, of course, the peanut butter and jelly company, along with Folgers Coffee and a number of pet brands and things like that. It is a dividend aristocrat, but anyway, it did report its earnings here today and disappointed investors. It wasn't a terrible drop, but nonetheless had come down a little bit. I don't know where that square is. There it is. It was down 1.8%. It was down worse than that earlier in the day, so it did come back a bit. But that may have kind of put a little bit of a wet blanket on what would have otherwise been an attempt out of the staples to rally today. So you're still not finding much, good behavior there. In terms of other areas that did poorly today, besides technology and staples, I would also throw healthcare into that conversation. There was some very interesting news that developed today, and many of you know that a number of big, large, and how do I explain it? Kind of more dividend growth oriented types of healthcare companies have really struggled here lately. Companies that come to mind in that regard would be Pfizer and Bristol Myers and Johnson & Johnson and AbbVie and Amgen. These are names that we would consider of top shelf quality in my dividend growth investing classes over the last 9 years, but here in the last several months they've come down hard, and of course their dividend yields have become much more enticing as a result of that. And there was some question of why that was happening, and of course you never know exactly what is going to affect a company's stock price, because they don't poll the buyers and sellers, hey, why are you selling your stock today, right? So there's not an official reason, but you just have to do your best to look at the news and guess as to why something may be happening. Well, anyway, some interesting news broke today. You can see that Merck was one of the worst performers, down 2.7% today, as they apparently are going to sue the U.S. government as a result of the U.S. government's involvement in trying to negotiate drug prices on behalf of Medicare. And the pharmaceutical industry is quite concerned that that is going to kind of turn a very profitable business into what is closer to a government charity. And obviously there's going to be a lot of headbutting before we get to the end result of that. If I'm not mistaken, when I saw a little clip of it on CNBC earlier today, I think they were saying that the negotiations will be happening here in the next couple of years, but it really wouldn't take effect until the beginning of 2026. So it's not something that's going to happen overnight, but it does have the potential to be highly disruptive, because these drug companies are very profitable and they have to take a lot of risk in developing new drugs. And there's always this social question about how much do you charge. And of course, if you charge too little, then there's less incentive for companies to innovate and develop new drugs, because the financial motivation isn't there. On the other hand, you can certainly understand the argument on the other side that suggests, hey, you can't gouge the very citizens that are paying the bills here. That's morally wrong. We should be able to get effective health care to everyone. And so you can see how it's not going to be exactly an easy issue to work out. But then again, when has it ever been, right? This has been an issue we've been dealing with for years, if not decades. But we do have to remind ourselves that there are a lot of very innovative drugs that come out of the American pharmaceutical industry. And if those incentives aren't there, it does make you wonder if we will lose our edge in the United States when it comes to that, and the profit seekers will go offshore, and then that doesn't really help our citizens either if we are not the ones benefiting in the U.S. from the innovations in the drug world. So it's challenging, and there's not a one-size-fits-all answer to this dilemma, but that perhaps is why we've seen the difficulties in some of these healthcare names in recent months, as kind of rumors probably started leaking out that was the direction that the government was headed. And of course, the major pharmaceutical companies don't like the sound of that at all, and I can't blame them, right? Their job is to be profitable organizations, and so if their highest profitability pharmaceuticals and drugs are going to be forced lower in price by the government, and they can't make the profits that they assume, then they might have to fire workers and shut down facilities and do all these kind of disruptive things for their shareholders and business moving forward in their local communities as well. But that was very interesting to me here today, and thought I would pass that along to all of you as well. So all in all, kind of an interesting day where clearly we had a lot more green than red showing up, which we appreciate, and it was a different type of a day because of the lack of outperformance by the mega cap tech area, which up until this point had, of course, been the torch carrier of this entire market. So it kind of fits that theme of what we really saw in earnest on Friday, when we saw the market advance to a much broader group of companies participating. That day kind of felt like a bit of a game changer, where a lot of the forgotten about sectors and industries really held up their end of the bargain for once on Friday, when we had that nice breakout to 9-month highs or whatever it was on the S&P 500. Before that, it seemed like every major advance day was because of that narrow leadership of mega cap tech, but Friday did feel a lot different, where it was really the non-tech oriented companies that were leading the charge. And today kind of feels a little bit like a follow-through of that to a degree from what we saw on Friday. What's weird about it is yesterday, I know David was with you, I wasn't, but he probably mentioned that yesterday it was kind of the normal where the tech was leading. So it's kind of wishy-washy right now. It's hard to say where it's going, but after such an enormous run out of the mega cap tech, you'd like to think that it's time for them to kind of take a breather a bit and for the rest of the market to have a little bit of fun and participate in this rally. So at least that's what I'm hoping for. We'll see if we can get it or not. All right, let's go ahead and pop on over here to the main part of the platform and see what the specific breadth numbers are. And you can see that when I pull the S&P 500 up here, 330 stocks out of the S&P 500 closed higher. That's good for about 66%, or in other words, 2/3 of the stocks in the S&P 500 closed in the green today, with basically 1/3 in the red. So all in all, a nice, solid, broad-based advance, especially from the smaller and mid-cap types of companies within the market. Let's go ahead and now go on over here to the charts and pull up our traditional foregrid. And you can see here that it was a promising day for many of these areas. In other words, this is an advanced day for all types of areas within the market, but the one that should really stand out to you the most is the one I've hinted to already. If you look in the lower right hand corner here, this is your Russell 2000. Look at that candle today and then compare it to the candles of the Dow and the S&P 500 and the NASDAQ composite. The Russell 2000 erupted today. And remember, this is really its second out of 3 days where it had this type of performance. Again, with Friday being that day that I just mentioned a moment ago, that felt a lot different to market participants, where it wasn't just a mega cap tech story. Here you've got the small caps participating in a big way. You gave back about half of those gains yesterday, and then you got back all of them and then some today. So, kind of one of those 2 steps forward, 1 step back, but that still results in a nice broad-based rally. And notice all of a sudden here with the Russell 2000's 2.69% advance, we are now talking about the highest levels for the Russell 2000 since back here on March 9th. And remember, that was right there in the thick of the Silicon Valley Bank blow up and everything else that happened as a result of that. So we've now kind of washed those sins away, so to speak, and now we are looking towards greener pastures as we are starting to head higher and clearing above that resistance that we saw there in the middle of May, clearing above that resistance we saw in the middle of April, and then also at the beginning of April. So you had kind of this nice 3 touch point horizontal line resistance area that was broken here within the last 3 days on the Russell 2000. So that's a very, very good sign. Remember, there's only 500 companies in the S&P 500. There's only 30 companies in the Dow. So to have 2,000 companies participating all at once, the way that we're seeing here all of a sudden, is a really good sign. So let's hope that can continue into the summer. We shall see. Obviously, if there's another bank blow up, all bets are off. But maybe this is the market's way of telling us we've evaluated the damage from the banking crisis. We're comfortable with where things are now, and we're ready to move on with life. Because remember, bank failures will happen again in the future. It is part of capitalism, I'm afraid to say. It's happened throughout time. I have no reason to believe it's not going to happen again. But when you see this type of an advance right here, it's basically saying, at least here in the intermediate term, it seems like market participants are comfortable with the risk of not having any more major bank blowups here in the short term. So we shall see. Anything can happen, right? Always got to keep your eye on the news and all that kind of stuff. But if you are judging by the idea that price is king and it's the only thing, well, price right now is telling you that things have calmed down in that regard and that there are brighter skies in front of us. So a great day there out of the Russell 2000. It continues to have a strongly bullish posture. Remember, it has since Thursday of last week. Now, when I was with you on Thursday last week, I remember our conversation was kind of like, yeah, we'll see how this goes, because right now, on that particular candle, it was basically just in the middle of this sideways range that we had been in for the previous 2 months. So I wasn't particularly enthusiastic about it on Thursday. But seeing what happened on Friday and then also today, that's why we look at this stuff daily, right? Because your mindset and your attitude can change based off of the evidence that you see, unraveling before you. And right now, this is some pretty strong evidence that the bulls want back into the small cap gain, in the small cap world. You can also see that the green line on the moving average suggests that price is above a rising moving average. Remember, when I was with you on Thursday right here, that was not the case. So we did have a switch to the bullish posture that day, but we still had the yellow moving average. In that particular moment, price was above a falling moving average. So the very next day, with that huge move higher, it was enough to pull that moving average up with it, and has continued to pull up with it there as well, with today's really solid follow through. So, all of a sudden here, it only took, a couple of days, but they were very important days. And it looks like the Russell 2000 wants a chance to play ball here. So let's see how this unfolds moving forward. In terms of the other charts, nothing nearly as exciting as what happened with the Russell. We had the S&P 500 up 0.24% today, but remember that kind of undersells what really took place. With 66% of the companies higher today, typically you're going to have a bigger advance than 0.24%. But the reason it was kind of muted is because Apple and Microsoft and Nvidia and Meta, those types of big companies, were down today. Had they all been up, then we would have seen a much bigger advance percentage-wise out of that market cap weighted index of the S&P 500. Even still, despite not having as exciting of a day as the Russell 2000, it's still a really good-looking chart, right? This is a decidedly upward trending security at this point, and it's the best barometer for corporate America, right? It's why the S&P 500 remains the most widely equity tracked benchmark on planet Earth. It is represented some of the most important companies on the planet. And when you're looking at this chart and you're saying the most important companies on the planet look like this collectively, that's a pretty good sign, right? Higher highs and higher lows, and we're not quite to 1 year highs yet. We still got to get up and over where we were in August. So if I change this to a 1 year chart here real quick, I'll show you. There's where that hump is back in August 16th right there. And that was at 43.25. And right now we're at 42.83. So, we're just a stone's throw away from taking that out. We have another good week or two, and we're talking about 52-week highs on the world's most important equity index. So that's a really impressive things, all things considered. So we'll see. One thing I should point out today, as I come back here now to the 3-month daily chart. Strangely enough, we actually got a bullish intermediate confirmation signal. Remember, those exist when you have the green line in bullish territory. In this case, it's in the upper reversal zone, but remember, even if it's traveling between 20 and 80 and it's going higher, that would still be bullish. But in this case, it's in the upper reversal zone on the same day that the red line is in the lower reversal zone. And so technically, this is a bullish intermediate confirmation signal, but most of you are aware by now, if you've been listening to David and I over the last decade or so that we've been doing this video, including our time at TD Ameritrade, you'll know that the blue line is not technically part of that signal, but we oftentimes use it to try to determine if we are in a prime location for that signal to exist. In other words, when the blue line is up here near the upper reversal zone, as it is right now, it's telling us that the signal, while it's true, it exists, it's real, it's just not an ideal setup. Because really the bullish intermediate confirmation signal is supposed to be a buy the dip signal. And while the market was down yesterday, that's hardly a dip, right? Usually you want a little bit more of a give back, kind of like a 2 or 3 day move lower. Like over here as an example, right? We had the green line in the upper reversal zone. you had the red line in the lower reversal zone on this day. Now, that was the third day of a 3-day sell-off. Right now, you look at it and you're like, that's not really buying the dip very much, or at least it isn't to me. Maybe some of you disagree. That's fine too. But I would just say that, yeah, the signal's there, but is it one that you would get excited about acting on? Probably not. You usually want more than just a 1-day pullback with that particular signal. Nonetheless, it is a strong chart, and it has a great looking trend, and that's what is very important in this market's eyes at the moment. It remains above a rising 30-day moving average and continues to have a strongly bullish posture. The Dow Jones is now the only index that does not have a strongly bullish posture. It has a weakly bullish posture. Notice the green background color here is a slightly lighter color than the darker green that you see on the other charts. So that's telling us in this case that the green line is rising between 20 and 80, but it hasn't quite breached the 50th percentile yet. You can see right here it's very close. It ended today at 47.10. So in all likelihood, if the market is up tomorrow again, it will likely change to that strongly bullish posture tomorrow on the Dow as well. But even still, another way to identify that the Dow just is not, pulling its weight the way that the others are, notice that the moving average is still falling. So even if we do go to a strongly bullish posture tomorrow, you still have a falling moving average to contend with. That moving average in this case is yellow. Notice it's the only one. These other charts all have green 30-day moving averages there. So anyway, the Dow remains a bit of a laggard. It's just kind of, biding its time. It's not like it's plunging or anything. It's not, horrible. It's just not really clicking, the way that you'd like to see it and the way that we're seeing with the other indices at the moment. Down below here, you've got the NASDAQ composite. And by the way, the Dow was up today, but just barely. It was the smallest gainer today. It was only up by 0.03%, so just barely higher today. The NASDAQ was up 0.36%. So slightly better than the S&P 500 and the Dow, but not nearly as strong of a move as the Russell 2000. Remember, this NASDAQ composite that we're looking at here is not the same thing as the NASDAQ 100 ETF that many of you are familiar with, the Qs. The Qs are tracking the 100 largest companies in the NASDAQ that are non-financial. And for the longest time, that was an important distinction, because when you're going through a banking crisis and you don't have any financials in your index, it's going to give you an unfair advantage than to all the other indices that do have financial exposure. But today was probably a bit of an opposite of that. I didn't check the Qs, but let me do that. And yeah, that was my hunch. You can see the Qs were actually down today. Not by much, but they were down 0.02% today. And again, that's probably because the Qs do not have financial exposure. And what allowed the Russell 2000 to erupt today? It was the financial exposure. So when you go back to the composite, remember the NASDAQ composite is a very broad index as well, or exchange, however you want to say that. It contains hundreds, if not thousands, of companies. So it's a really big place that you'd be hanging out. And this will have some financial exposure in it. So today was a rare day where the traditional composite outperformed the Qs. For the longest time, the Qs were the ones that were just crushing it to the upside because they have max exposure to mega cap tech and zero exposure to financials. Today, that didn't really pan out for them as well as others may have hoped for. But anyway, NASDAQ, similar to the S&P 500, looks great, right? If you're looking for strong trends, it's hard to argue with what you see right in front of your eyes there with the NASDAQ composite, and this is not new information, right? We've had basically a strongly bullish posture on the NASDAQ since pretty much this day back here on March 21st. So, we're 2.5 months into this largely strongly bullish posture that is just up, up, and away with very little in the way of give back. And that's what you want to see out of a bullish market environment, despite all of the controversy with inflation and rising interest rates and worries about recessions and this, that, and the other thing, right? There's always going to be controversies out there that we have to fight through. But in this case, price was telling us it wanted to go higher, regardless of what our personal thoughts are on that matter. So we do remain with a strongly bullish posture on the NASDAQ composite, and we do, of course, remain above that rising 30-day moving average there as well. By the way, I should have mentioned this when I talked about the Dow. The Dow also had a bullish intermediate confirmation signal, just like the S&P 500 did. In this case, it's not necessarily a great looking signal because the green line is not particularly strong right here. Technically, it is bullish, and technically you do have the red line in the low reversal zone, so you do have that signal. But notice how the chart looks so much different than the S&P 500s, which has the exact same signal as well. It's just that its green line is in the upper reversal zone, basically saying this is a strongly bullish trend. This is only a weakly bullish trend. And so of the two, you'd probably want to wait for a stronger pullback in the S&P 500 if you're looking for a buy the dips mindset, because if you buy the dip on the Dow Jones Industrial Average, let's say it dips again tomorrow, then you're starting to worry whether the trend will hold, because you'll be back below the moving average again tomorrow. Whereas if the S&P 500 falls tomorrow, you're still going to be above that rising moving average. So you're going to have a little bit more confidence that the strength in the S&P 500 will lead you to the promised land, at least in the intermediate term, a little bit more easily than what you would expect out of the Dow at this moment. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations. As I always say, as long as you guys are willing to take 5 seconds out of your day and click a button for me, I'd be more than happy to give you 3 hours out of my day that it takes to do these videos. So as long as we're up and over 100 likes, I'll be more than happy to give you a full-length video the next time I'm scheduled to do it. On the other hand, if you're kind of getting a little bit long in the tooth with these presentations and you've got plenty of other content that you'd rather be watching, feel free to not click like, and we'll get that message as well. And naturally, if there's less interest in receiving the message, there's probably less interest in producing the message. And so I'd be more than happy to give you a 15-minute version of the video on Thursday if that's what you prefer. And if that's the case, then don't click like. But for those of you that like these longer form videos that we're in the midst of right now, that are closer to an hour in length, that provide your 12 grid analysis and sector selector analysis and trade application examples and all those extra goodies and extras, then just take the 5 seconds out of your day to click like. I promise it won't hurt you. Nothing's going to bite your arm or anything like that. You don't have to be scared of it. It's just clicking a button, just clicking the heart button, and it really just takes 5 seconds out of your day. So thanks to those of you who do that religiously. I know there's a lot of you that do, and I recognize you, I notice you, and I appreciate you. Let's do some shout outs. Let's take a look at who was out there stepping up to the mic for me last time around. How about Philip and Scott? And we've got Brian and Lucius and Terry and Denise, Evermonies and Carl and Marty and Member and Bruce and Sandeep and Jessica and Roger and Dave and Ken and Tom, Charlie, HR, John. There's my friend Eric. I saw his pictures. He's on the beach in Mexico somewhere right now. I wish I was so lucky. I'm still dealing with my whole car saga here and trying to figure out how to get that fixed and all that across state lines. And so I could use a legit vacation. So I hope you're having a great vacation there, Eric. Also, thank you to Fred and to Teresa and Paul and Kirk and Ayakipa and Vernon and Kenneth and Prickly Trader and Margie and H. Patel. The list goes on and on and on. I can't get to all of you, but I do like to throw your name out there every so often, just so you know I'm acknowledging you and appreciating you at the same time. So thank you to all of you who do that. Please keep that up. Let's see what else we can find here today. Of course, we had a good day of classes here at Market Scholars. I taught my dividend growth investing class, and we concentrated on the financial sector because, of course, in the aftermath of the regional bank crisis, there are now a lot of very attractively priced financial companies out there. So we looked at perhaps a couple of them in class today to select one for our portfolio. And then David taught his options class today as well. He taught it at a slightly different time because he's got a lot of other things going on right now. So if you didn't catch his class live, he'll get that recording posted for you here sooner rather than later as well. But speaking of my dividend growth investing class, of course, what our concentration is on that class when we're building our portfolios is looking for companies that have long histories of growing their dividends in the past. Obviously, that doesn't guarantee anything about the future, but what it does do is give us a little bit more calmness of mind, knowing that if a company company has a long history of many decades of raising dividends, there's a greater than not chance that they will raise their dividend again. That's not a guarantee. Sometimes dividends have to be cut because conditions in businesses do change as the decades roll on. But in general, it is a reasonable approach towards the markets. And of course, our battle cry in my DGI class is to buy high quality merchandise on the cheap. So we look for those moments in time where stocks fall out of favor. We try to grab the most high quality, the best of them, when their dividend yields are attractive on a historical basis. And that's what you guys, you see me use quite a bit in this presentation when we talk about the dividend stair-step charts. Anyway, this particular post here was posted to the website over the weekend. Remember, even if you're not a member of Market Scholars, you can still access it for free. Just come up here to the blog part of our website at marketscholars.com and then come down to dividend growth investing. And in this case, just look for the one that says increases from the month of May 2023. And here you can see a whole slew of companies that did announce dividend increases last month. So lots of data there for you to sink your teeth into to kind of hunt down some good opportunities for your own long-term portfolio. So feel free to spend a bit of time on that if you want. Also, let's have a little chat here about the sector selector. And the sector selector gets put together on Friday evenings, and it is built specifically for my Monday morning top-down trend trading class. And there we look for stocks and sectors and industries that are exhibiting relative strength to guide our decisions for our portfolio. And in this particular case, we actually had all of our top 4, which is what we're interested in from a practical perspective, keep the exact same rankings as where they were the week before that. That doesn't happen a whole lot, but in this case it did. It just shook out that way. Technology remained number 1. Communications remain number 2, industrials remain number 3, and discretionary remain number 4. Now after that, every other ranking except for the bottom one did have a little bit of a shakeup there. But speaking of the bottom one, of financials, you'll see they have now completed kind of the full cycle there. Remember, this is a rolling 3-month graphic. Basically, you're looking at 13 weeks, and then I basically just always lop off the oldest one and add the newest one whenever I update it. So you can see here this dark green color stayed at the bottom the entire time. And of course, from a timing perspective, that makes sense. It was about exactly 3 months ago that we had the banking crisis back here. March 10th would have been that first date that you see there. So since March 10th to where we are right now here in early June, financials have been dead last on the sector selector. But based upon what I saw in the market today, I think there's a decent chance that could change when I redo this graphic here this upcoming Friday night. Now, obviously, we still have 3 more days of trading, so if the banks go straight back down for the next 3 days, then of course my sentiment around that will change as well. But right now, I'm liking what I see early in the week, and maybe, just maybe, for the first time in 3 months, financials can get off of that 11th spot. So we'll all find out here soon enough on that. But that's something that is definitely in the back of my mind and something I'll be very curious about when I put the statistics together on Friday evening. All right, let's go ahead and pop back on over here to the main part of the platform now. And let's pull up our 12 grid analysis. Starting here with chart 5A, that's our asset class 12 grid. A reminder that the background colors of these 12 grids will tell us what the current intermediate posture is using the market forecast technical indicator. So when you see that the charts are green, it means the current posture is bullish. If you see that the charts are pink, it means that the current posture is bearish. So let's go ahead and get started in the lower 2 corners, as has kind of been my habit here for the last couple of years at this point, because we learn so much when we investigate what is taking place with the US dollar and also with the current interest rate environment. So let's start over here in the lower left-hand corner with the US dollar. It had a solid day today. It was up 0.32%. Remember when I was with you last time, we were talking about this wacky candle that took place there. I still don't know exactly what happened there, if it was a fat finger mistake or what have you, but there were legitimate trades going on. So it wasn't just like it got reported wrong or something like that. And it happened like with 1 minute left in the day. So something strange. It felt like it was something mechanical from an exchange and matching up orders perspective that took place there. So I wouldn't read too much into that as kind of my point of it. It wasn't like it was legitimately seeing the US dollar just plunge in 1 minute's worth of time. That would make no sense at all unless there was like some sort of a crazy geopolitical event that took place. So anyway, that's a good reminder as to why you shouldn't go overboard with your initial hunch on something, because I'm sure there were people thinking the worst. There was some sort of conspiracy theory out there that, the US dollar was going to just collapse or something like that. And people probably, bit into that and, perhaps got stopped out of their long dollar positions or other things that when they look back here now, just a few days later, they probably regret, because the dollar is back up here to, really close to 3-month highs. You're basically sitting up there with a couple of those other candles. So the dollar remains strong. It remains with a strongly bullish posture. That was what was kind of interesting that day as well. Despite that really aggressive move lower, we still retained the intermediate posture. So if you were kind of using that as your guide, that would not have forced you to switch your mindset in it. And then you do remain above that rising 30-day moving average there. Now remember, a lot of times when the dollar is up, you will find that commodities are weak. We kind of saw a mixed bag in that regard today. Gold was up 0.11%. So in a one-day kind of inverse correlation, that didn't really make sense. But you can see that from a further look back period, it still kind of holds that relationship where the dollar has been strong for much of the last few weeks at the same time that gold has broken down and started trending bearishly below its falling 30-day moving average. So gold remains with a strongly bearish posture below its falling moving average. Oil was down today in the face of a strong dollar, so that perhaps made a little bit more sense. But you can see the background color on oil remains with that light green color, telling us we've got a weekly bullish posture. This is a chart that's kind of just meandering. It's what I would refer to as kind of trendless, unless you wanted to say sideways was the trend. But it definitely doesn't have a pronounced uptrend, and it really doesn't have much in a way of a pronounced downtrend either. It's kind of one of those wait and see types of charts. We don't know what direction the breakout will take place in. If the dollar keeps surging, you'd probably have to lean on oil struggling in that environment. On the other hand, if the dollar finally takes a breather and rolls over a little bit, then that could be an opportunity for oil to make a move back up. So right now, not a whole lot of extra insight there on oil. We just kind of have to wait until a breakout occurs. We're just stuck in this holding pattern. The 10-year U.S. Treasury yield was up today, not tremendously, but it's worth noting it's its third day in a row to the upside, and that follows 4 days in a row to the downside here last week. So, you kind of had a couple of pushes in both directions at this point, but, similar to oil, you kind of have a chart that's meandering. This one I think kind of feels to me like it's still wanting to sniff out that possibility of heading higher. But in general, you can see that where we are trading right now is pretty much smack dab in the middle of the high right here on the 9th of March and the low down here in, I guess April 6th would have been the low. And where we're at right now is kind of right directly in the middle of those two areas. So similar to oil, we're kind of in a holding pattern with interest rates right now as well. And maybe the market is just kind of awaiting further information from Jerome Powell. Remember, they do have an interest rate decision coming up. A lot of the Fed governors and what have you will be in their quiet periods. And so maybe markets are a little hesitant to make a big move before gaining, a firmer amount of information directly from the mouths of the Fed's officials. In the middle rung here, you will notice long-term U.S. Treasuries did have a pretty solid day, and that's a little goofy as well, right? More times than not, what you will find is that TLT and TNX move inversely to one another. So for instance, look at TNX is above its rising moving average, TLT is below its falling moving average. That makes sense. But one friendly reminder on a day like today, because sometimes this gets lost, TLT is not specifically the 10-year U.S. Treasury bonds. It is technically a basket of long-term treasuries. And so that can include 20-year treasuries and 30-year treasuries. Remember, TNX is specifically referring to what is the 10-year yield. So every so often, it doesn't happen a lot, but today is an example of that day where a basket of longer term bonds was not inversely correlated the way it normally would be to a very specific duration of a 10-year U.S. Treasury yield. But from an intermediate perspective, I think those relationships do still hold. And you can see that with the little bounce back that we've had on TLT. Remember, we talked about that here a couple weeks back as well, as TLT was giving us these oversold cluster signals. And I was saying I'm hoping for a reversion to the mean type of a move, because remember, I still have an iron condor going on this particular ETF for the trade application example. So, I had incentive for wanting a bounce, and I'm glad that we've received it. I'm not sure I'm particularly enthusiastic because it kind of feels like a little bit of a whimper of a bounce. Nonetheless, at least it stopped going down, and it did respond to those oversold cluster signals there. Now the question is it going to fail to break above that falling moving average, which is oftentimes what happens when you have that initial snapback reversion to the mean type of a move. Usually it does not succeed in changing the trend. It usually just kind of blows off the selling pressure steam by having a quick little move to the upside, and then it kind of resumes its downward move. So we'll see if that takes place in this case, and if so, under what time frame, because that of course can affect any of the options you may be trading as well in that regard. You can see that foreign bonds were up a touch today, 0.19%. They're basically meandering sideways. Not a whole lot to report there. It's basically just kind of trying to stick to that moving average. High yield bonds were also up, very small amount today, only 0.16%. But, that's a good sign for risk appetite that they did well, especially in the face of falling oil prices. And so 2 out of the 3 bond categories do have weekly bullish postures here. On the top rung, you did see that we had a bit more aggressive trading out of the foreign markets. Some of you might be wondering, well, what's up with that? Because usually when the dollar is strong, you have an opportunity for U.S. stocks to outperform foreign stocks. Today that did not happen, and I think it's the same reason for what we were talking about earlier on the heat map, and then also our conversation about the Russell 2000 and to a degree the NASDAQ. And from my perspective, I would venture to guess that the banks have a higher allocation in the foreign countries than they do in the U.S. Remember, the U.S. is controlled by mega cap tech. But mega cap tech does not have a major presence in most other countries, right? Most other countries don't have a Silicon Valley the way that we do. So most other countries kind of have older industries that kind of move them around, and banking is still huge in various parts of Europe and other parts of the world. So I kind of get the sense that today's move was able to offset the strength in the dollar, in the US dollar, because you had an over allocation towards financials in the foreign markets, and that was enough to kind of give them some giddy up and go here today. So you had a pretty solid move out of the foreign stocks. The developed ones were up 0.83%. They have a weekly bullish posture, still barely below a falling moving average. And then EEM all of a sudden, like a rocket ship, is just launching here. It wasn't up a massive amount today. It slightly beat the developed stocks. It was up 0.89%. But really, it's the trajectory in just a short amount of time that's impressive. This has pretty much all happened within a week. A week ago, it looked like, EEM was on death's doorstep. It was like breaking down below support areas, well below its moving average. And this sucker has just ramped to the upside here. So, you have that broader participation, it seems like, helping the emerging markets here all of a sudden as well. And then you also do see that the preferred stocks were up just a touch today. They did continue to have their strongly bullish posture, but their moving average does continue to fall to the downside. Should also mention Bitcoin. I talked about Coinbase earlier in the presentation and how it was getting sued by the SEC. But you might have wondered, well, what happened to Bitcoin? Obviously, that's the key cryptocurrency that is going to be traded at Coinbase. And wondering, is that good, bad, or otherwise for them? Well, here's another one of those situations similar to what we talked about last year with Sam Bankman-Fried and all all these other, scams and things going on at the crypto exchanges, sometimes oddly enough, it kind of reinforces the concept that Bitcoin itself can be trusted more than the exchanges that are allowing other customers to trade the Bitcoin. And so you kind of had that same type of effect take place here today as Bitcoin actually went up today and is slightly above 27,000. Now, before we get too excited about that, let's remind ourselves we're still below a falling moving average here. But at least you do have that weekly bullish posture, and on a really heavy news day for that part of the world, it could have been an excuse for people just to dogpile out of that particular asset class, and that did not happen. So, maybe there's a little bit more resilience there. Let's talk about sectors now, and we'll pull up chart 5C for that conversation. And right here, you'll notice that the financials I wanted to kind of hone in on, because that's been a big part of our conversation so far, and I'm just kind of scanning the other sectors just because I don't want to give you the wrong information, and now I can confirm it, that financials indeed were the best performing sector today. So it wasn't just a mirage what we were seeing there with the Russell 2000 and the heat map and all that kind of stuff. We can confirm it here, even on a market cap weighted perspective. The financial sector was up 1.26% today. That did lead all of these sectors here today. Discretionary wasn't too far behind at 1.04% to the upside. So those were your two winners today. Obviously, financials got work to do, but you're back above the moving average, whereas discretionary is kind of a follow-through of an already upward trending stock chart. I also wanted to point out healthcare. This is what that chart on healthcare looks like, and that does not look good, right? It was down 0.83% today, and it was the worst performer out of all 11 sectors. But it's not just the percentage that's concerning, it's how the chart looks. And you had this nice reversion to the mean rally after these oversold cluster signals go right up to the underside of that falling moving average where you would expect resistance, and boy did resistance show up. This was an ugly looking candle today, largely because of all that Medicare stuff that I was mentioning earlier, but it does have a bearish engulfing candle taking place right where you would expect resistance and the worst sector of selling on that day. So those are not particularly good combinations if you want to be bullish in the short term on healthcare. So be aware of that. I don't want to make too much of it because my interest in healthcare is longer term, but for those of you that are shorter term oriented, there could be some bearish opportunities in various healthcare charts here all of a sudden. All right, let's get into our trade application example now. And since the financials did so well here today, I wanted to stick within that particular sector. And so I went through a bunch of financials charts, and there were a number of interesting ones out there, but I was trying to look for something that had not taken off without us and was bouncing up and off of an important support area. And in this case, I came up with Unum Group, which is kind of like does annuities and insurance and different things like that. So it's not like a pure bank type of a thing, but nonetheless, the chart pattern looks at least reasonable here. As you can see, it has tried to bottom out at about $36 back here in March during the banking crisis, and has made its way all the way up to 45 as it stands right now. And in doing so, crossed above its moving average and had hit a new high of 46.99 here a couple of weeks ago, and then had this pretty significant pullback. But really all it did was it kind of got rid of the noise and the fluff of the chart. At this level, it was way too high above its moving average. By giving that back and kind of resetting the base on the upward trending moving average, it might give you another opportunity to play it to the upside. So that's what I did in today's case. This one does not have very liquid options, so I just chose to trade the stock itself here in the paper money account. And all I did was 1-for-1 reward risk ratio, basically buying it here with the bounce up and off of the rising moving average. Our upside price target is up here just a hair below the previous high. So it's at like 46.89, so 10 cents below the previous high there. And then our stop loss would be a couple of pennies below the low on this candle here on June 1st. So if it does roll over, we'll be stopped out of this before losing too much money rather quickly. On the other hand, if it can continue what it appears to want to be doing right now, which is bouncing up and off of that moving average, then we're going to be gunning for that prior high, and as long as it can get there, we'll be able to collect our profits and move on to a different trade. Okay. Remember, I always do these trade ideas when the market is open, and I send out that information to all of you premium members on our Telegram app, so that way you guys have information before the market closes and before everybody else who watches the free video. So make sure you take advantage of that as well if you're one of our premium members. All right, that's what I had for you here tonight. I hope you enjoyed the presentation. I hope you all had a great weekend as well. And if you want me to do another full-length video like this when I'm scheduled to do it on Thursday, make sure you click like for me. As long as we're up and over 100 likes, I'll be happy to do that for you. On the other hand, if you kind of prefer the 15-minute version without all the extra bells and whistles and just kind of stick with the indices, then don't click like. And as long as we're under 100 likes, then I'll just keep it nice and simple for you that day. So in the end, I'll let you guys decide collectively. Whatever you do decide, I appreciate you checking out tonight's video, and I wish you all the best of success with your trades and your investments. Goodbye for now.